Hello and welcome to another daily dose of insights powered by Container Exchange. My name is Christian, and every other day we bring to you the key news, stories, and data points that move container markets and hence your business. It's Monday, so it's Macro Monday. Let me quickly share my screen for you. It means that we always take a look ahead what's coming up in terms of macroeconomic indicators this week that move container markets and that you should pay attention to. This week, quite a bit of movement on the inflation and particularly on the interest rate decision front. We have the Fed coming on Wednesday, expected to hold rates stable at 5.25%, while the ECB is expected to continue to increase their key interest rate by 25 basis points to then 4%. That's coming up on Thursday. And then lastly, on Friday, the Bank of Japan continues to hold stable, or likely continues to hold stable, the interest rate at minus 0.1%. So Bank of Japan still a bit of an outlier here amongst the world's most important central banks. Alongside this, of course, we have inflation data coming in scattered throughout the week, not just in the EU, Japan, and the US, but also in a lot of the countries itself. Mostly we expect significant decreases in inflation and core inflation rates. For example, in Germany, the headline inflation rate is expected to decrease from 7.6% to then 6.3%. So this is always a year-over-year inflation rate. So this is quite a significant drop if it's driven just by 1 month difference within the 12-month period. This decrease also explains, of course, why central banks are now a little bit more cautious in their rate increases. They've seen that it works. They've seen inflation rates drop, and the momentum decreases a little bit. So central banks are becoming a little bit more cautious and either hold interest rates stable or increase only slightly. Then on the GDP side, on the overall growth side, the UK is scheduled to release GDP year-over-year data. The outlook here is beginning to improve, not just for this year, for 2023, but also for next year. Right now, the figure is expected to improve versus the last reading from 0.3% to actually 0.6%. So that is also a significant increase if you look at year-over-year figures, and there's only 1 month difference since the last publishing of figures. What this means, of course, for the rest of Europe, for the rest of the world economy, remains to be seen, but at least there are some positive signs or some light at the end of the tunnel. Apart from that, this was sort of all macroeconomic indicators that I wanted to briefly highlight. Apart from that, at the US West Coast, of course, on top of everybody's mind, no real improvements here in the negotiations. Congestion deteriorates accordingly because sailings continue to arrive, and carriers are also not seen blanking additional sailings on top of what they had already blanked before. So of course, volume will continue to flow in and essentially become stuck because port and terminal productivity is at a major low. And the second sort of accompanying news here, Asia met volume, so container volumes are actually picking up now the second month in a row with significant growth, pointing at maybe an early peak season, and maybe retailers are ordering a little bit ahead because they expect further supply chain disruptions, potentially also from the issues, for example, at the US West Coast, the Panama Canal, et cetera, et cetera. But that's sort of also their light at the end of the tunnel, maybe a little bit on the Asia-Europe trade. That's it from us for today. Thanks a lot for tuning in, checking out macroeconomic indicators for the rest of the week. Have a successful trading week ahead, and see you all on Wednesday. Take care.